Hello everyone, Happy New Year. Hope you're all doing great and had a great holiday celebration. I wanted to take a few minutes to say hello and introduce the new year in real estate, what's going on in 2017, and why you want to work with us. Well, 2016 brought with it a lot of new things, new rules, brought a whole new a new wave of market conditions, some that were positive and some that were negative. The new set of rules that now applies is about to get changed again. We have new administration coming into office, which is going to have a new set of rules. And we have yet to learn what that new set of rules is. So right now, what we're seeing in the markets is a little bit of skepticism, of course, a lot of positivity, and a lot of holding on. Holding on means that banks in particular are holding on to their properties, their REOs, the off-market inventories, sitting in the shadows. Some people call it the shadow inventory. You might have heard that. Now, these properties that have been sitting on the bank's inventory, the books right now, since the last George W. Bush era, where he gave all the banks the TARP funds. If you've ever heard of TARP, I know it's confusing. There's been a lot of HARP acronyms, and they all mean different things. The TARP was the money that the government gave to the banks to help them bail out after the crash, the Asset Relief Program. In fact, that's what it stands for, in case you don't know, the Troubled Asset Relief Program. See, the banks got paid for those properties for years. They got incentives for years on those properties, and the TARP funds ran out about a few years ago. And they've been sitting on the bank's books, and no one really knows why. Well, one reason, I think, is there's a lot of skepticism as to the direction of the country was going to, as it pertains to the election. So now that the election's over, we have a couple of things. We know that the interest rates are going to go up. Now, we have not only seen, as point of this recording, we've seen one small hike, but we're about to see more. Now, I've read up to 3 hikes this year. Now, we had forecast 3 hikes already, but just not in 1 year. We felt that it was going to be 1 in 2016, then 2 in 2017. Now some are speculating 3 hikes. Others I'm reading are speculating 2 hikes. None, I repeat, none, are speculating no hikes. So we know that the era of ultra-low, ridiculously low interest rates is about to end. Having said that, just as a side note, if you're in the market to buy a house, especially one that you're planning on living in for a while, now's the time to buy because you're going to be able to lock in this low rate for a long time. For investors, it doesn't matter as much. Anyhow, so we know interest rates are going to go up. And we know that there's going to be a period of what I would term expansion. Expansion in the financial markets, expansion in the banking regulations, lending. And that was something that was going to happen no matter who got into office. If Hillary would have won, it was going to be bank lending. Donald Trump won, it's going to be bank lending. It's bank lending no matter what, or no matter who got in there. It's time. There's no other way to really kickstart this economy. The only real way to do it is to lend and to get people back into homes. So there's much dead inventory, and it's time. It's that time in the cycle. And if you take a look at the cycle, we're yet again coming into another phase of the cycle that we've seen back in history. Now, some people are speculating that that phase is what is considered to be Reagan-esque. Now, a lot of people don't know what that is. I mean, I'm 40 years old. And when Reagan was president, I was not really old enough to understand what that meant. And I think that there's a lot of people, I tend to be a part of a fat age group, or age range rather, that represents a good portion of the population. So I'm pretty sure that I'm not the only one that wouldn't know what that means. Well, I can tell you what I learned that it means. And what it means is that it's a time of guarded and risk-averse economic growth that's going to be broad in spectrum. Now, if you take that as the working definition, then you can see very quickly that real estate was knocked out. How many years ago now? 2008, 2009, and maybe if you were paying attention, 2007, when it first started to happen, started to trickle in, and it was time for that. Prices had risen as a result of false pretenses, fraudulently, and it was their time. It was that sector. And then we saw the stock markets, and then we saw the bond market, and then we saw gold. Well, we saw gold coming. Gold was the one that forecasted. Gold came first. And you see the drop in gold and the stagnation in gold, and it too will have its day again. It will come around again, and it will get above the levels that we see here. The stagnation that we've had in the gold market for so long, and you must be saying, well, what does all this have to do with gold? Well, here's what it has to do with gold. It has to do with the fact that the financial markets are now, more than ever, tied to the real estate market. And guess which one is fueling which? Well, up until now, it hasn't been this way for a while. But going forward, it's real estate. The real estate is, well, back in the day, we used to have a silver-backed and a gold-backed dollar. Now we have fiat currency. We have nothing backing our dollar. Well, through the vehicle of the stock market, we have essentially a real estate-backed market. And so, as a result of it, I think that the timing is perfect right now. it seems to be entering into what I'm going to call a perfect storm. I think that the perfect storm is going to last about 24 months. But that 24 months doesn't start now. That 24 months started about 6 months ago. So I think that we've got about 18 months left of what I think is going to be a steady stagnation in real estate prices. It's not going to jump real crazy, and I don't think that it's going to dip very much either. I mean, there's going to be pockets around every area, in every city, states, throughout the country, neighborhoods. There's always going to be pockets. But just generally speaking, across the board, we're going to see some stagnation. And why that is, why I believe that to be, is because I think that they now have incentive to take these, what are now properly considered non-performing assets, although we didn't know that they were appropriated as such in the past. We now have an environment where the banks are in a position where they can put these properties back on the market. And that will continue to back the stock markets and in the same sense back the dollar. But how can they do this? How can they put these properties back on the market? Could they have put them back on the market before this time? No. Because who's going to buy them? Who's got money up until now? So right now, there's just been enough time for people to have saved up a little. Have reserves been the same or higher than they've been in the past or lower than they've been in the past? Yeah, maybe. Maybe a little bit higher than they've been in the past. I mean, of recent past for sure. And probably lower than they've been in the past too. But people have reserves now. They're starting to get reserves now. Yeah, they're starting to build them back up a little bit. Not enough to be going out and paying cash for homes. So how much is it that most people have saved up right now? Well, maybe enough for a down payment. Yeah, that sounds about right to me. Enough for a down payment. And to double check this philosophy, you think that all you got to do is take the average sale price of a house right now in your particular area and then divide that by the nation's average, what the nation's average reserves are, and it seems to be right about 20%. Actually, between 8 and 20% to be exact, it's the number, because there are now lower down payment programs and they're becoming more popular with certain types of loans from lenders who are starting to get more creative again, which is what we're seeing. And that's another thing that supports the theory. All right, anyhow. So in order for these properties to get off the bank's books, in order for these properties to get back onto the market and for them to actually produce, you have to have buyers. So lending was happening either way. People are now having enough money saved up to be able to go back into the house and finance it. So as the banks are dripping these properties back into the market, you're going to see people finally able to get a loan for them. And the two are going to balance out. Banks aren't going to dump a whole bunch of properties on the market at one time. Why not? Why not? Well, everybody's been arguing with me on this point, but I'm very confident that I'm right here on this. The reason is because now that they're finally lending, you have an interest rate, right? You all know how an interest rate works. It works with lending, right? It's pretty simple. Let me simplify it. The banks lend money. They get a percentage of that money back and on an amortized scale as a payment for it. Well, would you rather lend money on a lower amount or on a higher amount? Higher amount, right? So banks don't have much control over those interest rate figures. The Fed sets the rates, and then the banks lend on top of that. They add their fees or whatever, but they all have to be competitors. So as a bank, you can't just say, well, I'm going to go in and lend at 10% and make money that way. No, that's a hard money loan right now, and that's a different story. So what can they do? The banks can control the amount of property that are being put on the market at one time, so they don't drown themselves and start driving the price of homes. You see, banks want to lend on properties. They want to lend. They're lending to each other based on the rules of lending, but they want to lend, and they want to lend at a higher value. So they're not going to flood these properties onto the market. You're going to see them drip into the market. And the amount of properties that are going to come onto the market are going to be based on one simple premise. How quickly can people get a loan, and how many people can actually get a loan to buy these homes? So you're going to start seeing them coming into the market pretty slowly. They're going to drip them into the market, and depending on how much that market can hold, which is called the absorption rate, how much that market can hold and how long it takes for that market to absorb those properties, meaning to sell them, that's going to be the indicator that we look at for when these housing prices are going to start to move. Because what they will do is likely want to keep housing prices about the same, so that they can build up a huge book of loans that have been written at a good price, and then be able to go back to the stock markets and say, hey, we had a killer quarter, and we have outlooks on another killer quarter coming up, and the cycle continues. So you get my point. And just so you know, I appreciate you guys getting into and sticking with this for this long and allowing me to get into my point. But my point for putting this out there is for education. Everyone, whether you work with me and our team at the REIG Real Estate Investment Group, or if you work with somebody else, our team is phenomenal at doing this. That is what we do, and this is how we advise our clients. This is how we discuss with our clients and the information that we provide to our clients. So whoever you're working with, it doesn't matter. You have to make sure that they understand and you understand what it is that we are currently in order for you to make a good decision. And that's true in all respects, all aspects. So take the time to educate yourself. I'm proud of all you who are. Click like. Share with anybody who you feel this information could be useful to. I appreciate all of you. I thank you very much for being my fans, my followers, and my clients. And I hope to do business with you in the near future. This has been the 2017 State of the Market Address and Outlook.